from Marc Faber, editor and publisher of the Gloom, Boom and Doom report. He joins us from Hong Kong this morning. Marc, welcome to The Trade. A 3-year lifeline for Greece. What do you think, Marc? I mean, the best case scenario, but the best case outcome for Greece and the rest of Europe, you think?
Well, I think basically it's another process of monetization. We have now synchronized monetization in the world, and what it means is essentially the euro will remain weak and there'll be more bailouts. And for Greece, this means terrific austerity and a terrific recession. Now, the problem with a recession in Greece, if you diminished the budget deficit from 13% of GDP to 3%, is that as the economy shrinks, the ability of Greece to pay its interest will also diminish. And so they may default sooner or later anyway. But in the meantime, certainly that isn't optimistic or favorable for the euro, but it's of course favorable for resources. I'd like to add about resources. The tax that Australia is introducing is negative for the companies that produce resources, but it's positive for the commodities because it will contain the supply.
Marc, you said that there could be more bailouts from now on. Are you then saying the risk of a Greek contagion has not been eliminated?
I can tell you all governments will eventually have to be bailed out in the Western world. It's either going to be through money printing, as I think, or default. But they are over-indebted, especially if you consider the unfunded liabilities that arise from future pensions, from Social Security, Medicare, Medicaid, and so forth. It doesn't add up. They'll all default or they'll all print money. But the outcome won't be pretty, that I assure you.
It won't be pretty. You've said before that it is time to kick Greece out of the EU. Do you still hold that view? Is it too late to do that?
Well, basically, the best is to swallow the hard medicine and when you have a financial problem, to let companies that are weak go bankrupt. And the same in the world, if you have weak governments, you have to look at Greece like a corporation. There's no way that Greece can pay its debt. It's over-indebted. The debt has to be restructured and not just shifted to the EU. So the best would have been essentially to leave the EU and default. But of course that is unacceptable for many governments because the banks have lent so much money to Greece already.
Marc, in 30 seconds, how about the cost of the Greek debacle on global growth? Is there a chance the momentum in the global economic recovery may be slowed or derailed?
I don't think that Greece will have any impact, but basically the sovereign debt problems will have an impact. The over-leveraged consumer will have an impact. And what will also have an impact is now the lessened impact of the stimulus package in the United States. And then we have the markets that are telling you that something is not quite right because a lot of commodities, industrial commodities, have been coming down.
Marc, do you still think China faces danger signals from credit expansion and surging real estate prices? Have measures to curb surging growth worked at all?
Well, I think the signals are all there. The symptoms of a major bubble are all there. And I'd like to remind you and your viewers of the following. Ahead of the 1873 World Exhibition in Vienna, there was a lot of hype about this World Exhibition at the time, and there was a huge property boom in Vienna, Austria, and Prussia. And then about 6 months ahead of the opening of the World Exhibition, the stock market started to tank. And what followed thereafter is the Great Depression of the 1870s that lasted until 1885 and was like the Great Depression of the 1930s, a devastating deflationary bust. So I think the opening of the expo in Shanghai is not a particularly good omen.
Quite a scary thought there. Let's take a look at the Shanghai Composite Index. Trading at 22 times earnings compared with 17 times for the MSCI Emerging Markets Index. Looks like China is still not looking very cheap at this point in time. Your thoughts on that?
Sorry, I didn't understand the question.
What are you making of valuations in China?
Well, basically, I think that stocks, by and large, are kind of fully priced. Now, I'd like to make one point is, if China contains speculation in properties, the money could flow actually into the stock market. But the stock market technically doesn't look good because it peaked out already in July 2009. And since then, it's been in a downtrend. Then it made another high in November 2009. But that high was below the peak in July 2009. And now we're down. The same, the Hang Seng Index hasn't made a new high above the November 2009 high. So I think the market is telling you that something is not quite right. Then you look at industrial commodity prices, and you look at industrial sensitive countries and the currencies, whether it's Australia or equities like Freeport, BHP, Rio Tinto, they all act heavy. So I think that the Chinese economy is going to slow down regardless.